Hi, I'm Eddie Sundergy and welcome to Your Finance TV. It's Friday, so who else would I be here with? Jay Pelosky from TPW Advisory. Jay, how are you, sir?
Oh, Marty, pretty good, buddy. It's my last day before vacation, so I'm trying to get out of Dodge. And as usual, you
As
know,
usual, bro, I'm so excited we get to spend the last time in the office with you for the next couple of weeks, and it's with us, so we're very privileged.
well, happy to do so.
So,
Always
Jay,
good
you
to.
publish your weekly musings as usual on a Friday, and this week's titled True North. Why don't you talk us through your title here?
Well, I think we're in a transition period, Marty, both in terms of global macro backdrop, let's say, as well as kind of the investment opportunity set. And so periods of transition are always tricky and people struggle for direction, right? And we even see that in the markets, right? We've had a big run up in equities, big sell off in bonds, and now the market's chopping around trying to figure out what's next. And so for us, as I was thinking about this, the phrase "true north" came to my mind, and true north is the correct direction or the right set of coordinates to lead you to where you want to go if you're looking at a map or trying to follow a path or something like that. And so true north to us is what we expect to see coming down the road, which is a shift from monetary policy to fiscal policy and a shift from worrying about recession to a global manufacturing recovery and rebound.
All right, so that's true north. So that obviously makes you focus at some point on your direction. So what is your true north, and what are you focusing on?
Well, I think for us, really, it's that shift from a monetary policy fixation to much more of a fiscal policy. We wrote about this at some length last week with our monthly, where the title was an ode to competition, and we talked about really the first competition in the tripolar world, where you have all three regions, Europe, Asia, and the Americas, competing on things like electric vehicles, for example. And then it's the first competition in the AI age. And you see that again with the competition for high-end semiconductors for different regions trying to generate semi-fab plants to be located. Germany is the most recent example. In the last 2 weeks, Germany has announced fab plants to be set up, one by Intel and one by Taiwan Semiconductor, both of which come with significant state subsidies to support the decisions to locate in Germany for those plants. And that's the fiscal policy side of things, right? What we call the new industrial policy under Biden, for example. Europe's trying to do the same thing. China has already been driving, state policy, right? Policy is effectively state driven in China. And it's kind of interesting, again, wrote about this last week, but fleshed it out again in the musings today. The two big powers are the US and China are effectively switching strategies, right? China has been state directed and they've used that to great effect in the climate space. And they now lead pretty much throughout the entire climate mitigation, from renewables to electric vehicles to batteries, et cetera. And the US is now adopting industrial policy to compete with China. And China is adopting US policy in terms of trying to stimulate growth via domestic demand and domestic consumption, which has been obviously the driver of the US economy, with 75% or so of US growth driven by consumption. And so it's really a fascinating period of time. And we're really watching to see how this plays out over the second half of the year in particular.
So Jay, that's great to see your focus, and obviously we'll discuss your model portfolio afterwards. But how is this changing your mindset from an investment perspective?
Well, we're really focused at this point, Marty, on two specific issues for the second half, right? Our true north is that we're not going into recession We're going to have a global economic recovery. It's going to be balanced between consumption and production. And so we're really looking for two things. One is a manufacturing recovery in the second half of the year. And then the second is a pickup in Chinese economic activity. So let's take each one in turn, right? We'll spend a couple minutes on the manufacturing, a couple minutes on China, and then we'll finish up with updating our models, which, as you pointed out, we just did over the past week. So really the shift on the manufacturing side is we believe we're coming to the end of a destocking period, right? Where inventories piled up as a result of COVID and then supply chain confusion, and all this inventory built up. And so production really slowed. And we've seen that with manufacturing PMIs being below 50, certainly in the United States and in Europe for much of the past year. Now we believe that destocking is ending and it's shifting to a restocking, as disinflation means real consumer income, right? For the last 5 months, real incomes have been growing in the United States. As inflation comes down, consumer confidence picks up. We've seen very sharp pickup in consumer confidence. That should lead to increased spending. That should lead to a need to produce more, to rebuild those inventories. And we're already seeing signs of the manufacturing bottom and starting to pick up. I'll give you just two or three. One is that trucking and rail data in the US are coming in above expectations for the summer, right? Summer is usually a slow period. Instead, trucking and rail demand is starting to pick up. We also have had new orders pick up in the United States and in Europe. And JP Morgan pointed out in one of their research pieces that global manufacturing PMIs have bottomed versus services and are now starting to turn back up. So we're of the view that we're going to see a manufacturing recovery, that in, for example, in the US, that the ISM is going to break above 50 as we move through the course of the second half of the year. And this balance between production, or consumption and production rather, is going to lead to a global economy that's going to be stronger than expected. So not only are we not going to have a recession in 2023, we think it's highly unlikely that there'll be a recession in 2024.
Well, that's always good to hear, Jay. I like that. That's always good positivity there. So you mentioned China as well. Is this another point of focus for the second half of the year?
Yes, exactly. And actually, I just took a quick glance at my notes and realized I forgot a very important point, which is that earnings have come in, again, better than expected for Q2. We're about done. And more importantly, the 12-month forward blended EPS number has turned up pretty sharply. And that goes alongside and corresponds with the report from FactSet that suggested that U.S. companies are expecting to really pick up their CapEx expenditures over the course of the coming year. And that dovetails with the reality that buybacks have been shrinking in the US, right? So for the last couple of years, companies have been using excess cash to buy back stock because they didn't really need to do CapEx with all the uncertainty of COVID. Now, earnings are growing, margins are expanding, and so companies are starting to make plans for that to stimulate CapEx. And that's just another support for this idea of a manufacturing rebound. So that's the manufacturing side. On the China side, yes, we think that the second half of the year data is going to improve. And I'll give you a couple of examples. One, we just had the July CPI for China, which actually headline was negative, right? So arguably deflation in China. That got a lot of people concerned. We just also had the lending data come out, I believe, overnight. That disappointed a lot of people. It was quite a bit lower than people expected. And so there's a lot of angst around the Chinese economy, and we think it's overdone, right? On the inflation side, just point out that core inflation in China is running at 0.8%. doubled month over month. So core inflation is not showing signs of deflation. We actually think that we're at the nadir, the bottom of kind of the negativity around China. And I'll give you another example. Bank of America has this this indicator they call risk love, and they said that in China it bottomed on July 21st, so just a couple of weeks ago. And historically, when it bottoms, the next 12 months, the returns in Chinese equity are quite solid, running at about 25% on a per annum basis in the following 12 months. And I'll just kind of dovetail that with the Alibaba earnings and some of the other China tech earnings starting to come out, which was quite a bit better than expected. And then finally, and very importantly, we just note that the U.S. has been talking about really limiting U.S. investment into the China tech stack. And we finally, after a year or more of waiting, the Biden administration publicized their executive order for a period of commentary on it. And it was really not as bad as people felt it was going to be. The U.S. is using this phrase, small yard, high fence. In other words, they want to like restrict U.S. activity in the China tech stack to a small segment of the tech stack, but have it really be walled off. And obviously, you know, one can gather that that's the very high end of the tech stack chain. And so that executive order has finally come out. We think it's a really good hurdle to get over, right? It removes a lot of uncertainty. So when we look at kind of, you know, the CPI bottoming, when we look at China's also dealing with destocking, the trade data was very weak. It just came out over the last couple of days. Imports were down double digits, exports down double digits. So the restocking is likely to happen in China as well. And then you have the improvement in terms of the government attitude towards their private tech sector. They recognize in the AI age, they need to have the private tech sector kind of doing good things, feeling good about things. And so that risk love indicator that I mentioned from B of A, also bottoming, tells us that there's a lot of stuff that's kind of bottoming in China. And then the last point, which you'll get a kick out of, I was on Bloomberg TV this morning, that other network, and just as I started talking about China, the lights in the conference room went out, and so I was in the darkness, literally on live television, talking about China. So I made a joke about, you know, as soon as you start saying positive things about China, they turn the lights off.
Well, Jay, we'll have to beep out that other network's name, but you know, duly noted. But that's actually very funny. So thank you for running us through all those points. There's definitely some green shoots and positivity out there by the sounds of things. So what do we do? You've got your model portfolios. How have you restructured those, and how should we be restructuring things?
Yeah, exactly, Marty, right? You're a veteran of the business. You know, it all boils down to what are you going to do about it, right? What do you change with your investments? What do you note, et cetera? So for us, as you know, and for new viewers, I know your network is always generating new viewership. So for new viewers, here at TPW Advisory, we offer two model portfolios in our model portfolio delivery service. One is a global multi-asset. We call it our GMA, global multi-asset. And the other is our TPW 20 ETFs expressing thematic themes around future tech and climate. So the first point I would just note is that every month when we do our monthly update, we go through the technical positions and all the different holdings that we recommend. And what was really striking this time, Adi, was how many are above their 200-day moving average, right? Which is a technical level that people like to see. A lot of technicians, we're not technicians, but we use technical analysis. A lot of technicians say they don't want to be involved in stuff that's under the 200-day moving average. So for us, we calculated that 90% of our global multi-asset model is above the 200-day moving average, and roughly 70% of our TPW 20 is above the 200-day moving average. And that both those numbers correspond to the S&P, which is about 75% of the S&P 500 are above their 200-day moving average. So technically, the holdings are solid. That allows us to feel good about the little pullback we've had in the markets. We see that as healthy after a 16% up move in the first half of the year by ACWI, by global equities. So solid technical positions. We have discussed rotation over the last several months, right? 3 months ago, we wrote a Musings called Rotation in the title, arguing to rotate from big tech to cyclicals. And now we're looking to have this theme of rolling rotation. And so we want to roll that rotation thesis into two areas for the second half of the year. The first is emerging market, both debt and equity, where we think this global manufacturing upcycle is going to really benefit the emerging markets, which will also benefit from the rate cutting cycle that we anticipate starting to happen. And we again have discussed this. And just in the last 2 weeks, both Brazil and Chile have led the way by cutting interest rates. And there's significant room for rate cuts over the next year, 400 basis points or more in Brazil and Chile as an example of the rate cutting cycle we believe we're now transitioning to. Rate hikes, we think, are finished. Fed is done. Now starting rate cuts led by the emerging markets in Latin America. So we want to continue to build our emerging market debt and equity exposure. And we added to that exposure in this latest update, particularly in China tech. So we want to take advantage of the bottom in the risk love indicator in China, position there via the tech stack, which has now gotten through the executive order worries about President Biden and what the U.S. is going to do. So that's one. And then the second area that we want to kind of rotate into is commodities, right? So our view is that no recession, global manufacturing rebound, interest rate cuts, capex boom, commodities should do well. And so we've had a strong, solid position in commodities, but we're adding to it because commodities have been big laggards over the last year, but are now starting to break out. And we note that in our musings. And so here we've added to the energy space and we've added to uranium in particular, which we see as a really good tie into what's going on the climate side as well. So continuing to be positive towards risk assets as we go through the second half of the year into 2024, earnings estimates turning up, Fed done, rate cuts coming, manufacturing recovery coming. So we want to expand ourselves a little bit to the periphery and move into emerging markets, move into the commodity space. And that's really where we think the opportunities are. And the last bit, which is really a positive, is that JP Morgan do really nice work on kind of what's in the price of different assets. And they noted over the past week that commodities have the biggest recession risk priced in of any of the major assets. So even if we're wrong and there is a recession, commodities have already priced the bulk of that in. So we really like the risk reward in the commodity space for the second half of the year.
That's really interesting, especially on the commodity side of things. I had not seen that. So we're always learning stuff from Jay Pelosky at TPW Advisory. Jay, what are we going to do for the next 2 weeks without you?
You're going to fill the space, I don't doubt. But Marty, you won't be offended if I tell you I'm not all that worried about it.
I'm sure you're not. Listen, Jay, have a wonderful time on vacation. We'll see you in September. And, as always, thank you so much for sharing your thoughts from TPW Advisory.
Great to be with you, Marty. Take care now.
And everyone, we'll catch you next week. But, good luck investing.